Serious. 90% of the candlestick patterns you've memorized have no measurable edge. None. Zero. And the worst part is, you can keep winning with them for months before that catches up to you. Let me explain how that's possible and why it almost destroyed my account before I understood it. I used to have a folder, screenshots of every candlestick pattern from every book I owned. Hammers, engulfings, morning stars, dojis, shooting stars. I could spot them on any chart, on any time frame, instantly. I thought that was skill. It wasn't. It was memorization, and memorization isn't an edge. Here's the thing nobody tells you when you're starting out. A candlestick pattern by itself, with no context, is just a shape. Shapes don't move price. Liquidity moves price. Institutional order flow moves price. A hammer at a random point on the chart means almost nothing. The exact same hammer, at a level where real volume sits, where stops are clustered, where the structure actually matters, means something completely different. Frustrated, I traded shapes for almost a year. I'd see a bullish engulfing and take it because the book said bullish engulfing means buyers are in control. Sometimes it worked, sometimes it didn't, and I never once asked myself why. I just assumed I needed more patterns, more confirmations, more indicators stacked on top. That's the trap. That's how traders end up with 6 indicators and 0 clarity. So let's actually break this down properly because this is longer video than usual and I want to go deep on something that took me 2 years to actually understand, not just repeat. First, why does a working pattern still fail so often, even in books written by people who clearly know what they're talking about? Because most price action books teach you shape recognition, not statistics. A hammer at support usually leads to a bounce. Okay, usually according to what sample size, tested on what asset, what time frame, what market condition, bull market or range or crash. Nobody tells you that part because it's not as marketable as this pattern means reversal. The books sell certainty, the market sells probability. Those are not the same product, and confusing them is expensive. Second, confirmation bias makes this worse, and it's sneaky about it. Once you learn what a bullish engulfing is supposed to mean, your brain starts finding it everywhere, and it starts remembering the wins more vividly than the losses. You take 10 engulfing trades, 6 lose, 4 win, but the 4 wins feel like proof the pattern works, and the 6 losses feel like bad luck or I entered too early or the market was choppy that day. You're not evaluating the pattern, you're building a story that protects the belief you already have. Serious. This is the exact mechanism Mark Douglas describes as the difference between what actually happened and what you remember happening. Your memory of your own trading is not reliable data. It's a narrative your brain constructs to keep your self-image intact. If you want real answers, you need actual numbers, not memory. Third, and this is the one that really changed how I trade, sample size. If you backtest a pattern on 50 trades and get a 60% win rate, that number means almost nothing yet. 50 trades is not enough to separate real edge from random variance. You could flip a coin 50 times and get 60% heads. It happens. It's not rare. If you don't understand basic statistics, you will mistake noise for a system, and you will size up on that system with real money. Here's a concrete example from my own testing. I backtested a shooting star reversal pattern on BTC, 4-hour time frame, over 3 months. 68% win rate. I got excited. I almost built an entire strategy around it. Then I extended the backtest to 18 months instead of 3. Win rate dropped to 49%. 3 months of data had lied to me completely because 3 months happened to be a strong downtrend, where shooting stars naturally look predictive simply because price was already falling. Size. That's called curve fitting, and it is the single most common way retail traders fool themselves into thinking they found something real. So let's talk about backtesting properly because most people do it wrong in a way that guarantees false confidence. Mistake number 1. Cherry picking your sample. If you scroll back through a chart looking for clean examples of a pattern, you are not backtesting. You are selecting the outcomes that already confirm what you want to believe and ignoring every messy, ambiguous, or failed instance along the way. Real backtesting means you mark every single occurrence of the setup in order, without skipping the ugly ones, and you track all of them, wins and losses, no exceptions. Mistake number 2. Testing on too short a window. 3 months is not a backtest. It's a snapshot of one specific market regime. You need enough trades and enough different conditions, trending, ranging, high volatility, low volatility, to know if the edge survives outside the exact conditions you happen to test it in. Mistake number 3. Ignoring transaction costs and slippage. A strategy with a 55% win rate and a 1-to-1 risk-reward sounds break even before costs. After spread, after slippage, after funding fees on perpetuals, that same strategy is often a slow bleed. I've seen traders proudly show me a backtest with a nice equity curve, and when I ask if they included realistic slippage, the answer is almost always no. Mistake number 4, and this is subtle. Testing the pattern in isolation, without the context it needs to actually mean something. This brings me to the real point of this video. Calm. Patterns don't fail because patterns are useless. Patterns fail because they're being tested and traded without the one thing that actually gives them meaning: market structure and liquidity context. Here's what I mean. Concretely, a shooting star candle at a random point in the middle of a range tells you almost nothing. The exact same shooting star candle, forming exactly at an untested supply zone, right where a previous impulsive move originated, right where real orders are sitting unfilled, means something completely different. The candle shape is identical. The information content is not, because context changes everything. This is the entire reasoning behind the order block approach, and it's why I stopped trading raw candlestick patterns years ago and built my framework, polytrends, around structure and liquidity instead of shape recognition. Let me walk through the actual logic, slowly, because this is the part that matters most in this whole video. An order block is, in simple terms, the last candle or cluster of candles before a strong, impulsive move away from a level. That impulsive move suggests real institutional-sized orders got filled there. Price often returns to that same zone later, not because of magic, but because unfilled orders and stop clusters tend to sit around those levels, and price is frequently drawn back to areas of inefficiency or unfinished business before continuing its actual trend. The key insight that most retail traders miss completely: an order block only has real statistical value if it's untested. The first time price returns to a genuine, previously unmitigated order block, the reaction tends to be sharper and more reliable because the liquidity sitting there hasn't been absorbed yet. Once a zone has been tested and retested multiple times, the orders sitting there have likely already been filled, and the zone's predictive value degrades fast. This is the gained or lost levels concept in polytrends. First touch matters enormously, and most traders never account for this at all. They keep trading the same zone on the fourth or fifth retest, wondering why it stopped working without realizing it stopped being a real level 3 touches ago. Next piece, swing failure pattern confirmation. This is where price wicks beyond a level, triggering the obvious stop-loss cluster sitting just past that level, and then closes back inside the range. That wick and reject behavior is a strong signal that a liquidity grab just happened, meaning weak-handed traders got stopped out right before the real move. Combining an untested order block with a swing failure pattern on the retest gives you a much higher quality signal than either concept alone, because now you have both structure and a confirmation of a liquidity event, not just a shape on a chart. Third piece, and this is the one people skip because it takes more effort: VWAP alignment. If price is respecting VWAP as dynamic support or resistance in the same direction as your order block setup, you now have three independent forms of evidence pointing the same way: structural context, a liquidity event, and a volume-weighted price benchmark. That's meaningfully different from "I saw a hammer candle." Frustrated? Here's a real trade from my own history that shows exactly why this matters. Early on, I took a bullish engulfing candle on BTC purely on shape. No context. No liquidity check. Looked textbook perfect on the 5-minute chart. It failed almost instantly, and in hindsight, it was forming in the middle of a range, at a level with zero significance during a low-volume session with no real participation. The pattern looked right, the context was completely absent. That's the difference between pattern trading and structure trading, and it cost me real money to learn it the hard way. Now let's talk about timing, because context isn't only about price levels, it's also about when you're even looking at the chart. Session timing matters enormously, and almost nobody talks about it seriously. The London Open, roughly 8 to 11 a.m. GMT, and the New York Open, roughly 1:30 to 4 p.m. GMT, are where the overwhelming majority of real institutional volume enters the market. A perfect order block setup that forms during the Asian session in low liquidity, thin order books behaves completely differently than the identical setup forming right as London opens and real size starts moving. Trading only during these higher volume windows isn't a superstition, it's filtering your setups by when the smart money is statistically most active and letting the rest of the day pass without forcing trades into thin, unreliable conditions. Serious. This is where psychology and structure connect back together, because here's the uncomfortable truth. Even with a legitimately better framework, structure plus liquidity plus session timing, you can still sabotage it with bad psychology. A great setup executed with an oversized position, move stop loss, or revenge trading mentality still loses money, just slower than a bad setup would. The framework gives you a real statistical edge. Your execution determines whether that edge actually shows up in your account or gets eaten alive by your own behavior. Let's talk numbers for a second, because this is where a lot of traders' intuition badly fails them. Expectancy is what actually matters, not win rate. A strategy with a 40% win rate and a 1 to 3 risk to reward ratio is dramatically more profitable long term than a strategy with a 70% win rate and a 1 to 0.5 risk to reward ratio. Do the actual math. 40% winners at 3 times your risk, minus 60% losers at 1 times your risk, nets out clearly positive over a large enough sample. 70% winners at half your risk, minus 30% losers at full risk, is far thinner, and one bad losing streak, which will happen eventually to any strategy, can wipe out weeks of high win rate gains in a handful of trades. This is exactly why chasing a high win rate, which is what most candlestick pattern trading implicitly optimizes for, is often the wrong goal entirely. You want asymmetric risk to reward, first touch untested levels, confirmed by a liquidity event, taken during high participation sessions, sized consistently at a fixed risk percentage, regardless of how confident you feel on any individual trade. Which brings me to position sizing, because I see this mistake constantly. Risking a fixed dollar amount per trade instead of a fixed percentage of your current account is a subtle but serious error. If your account grows, a fixed dollar risk becomes a shrinking percentage, which is fine on the way up. But if your account shrinks, a fixed dollar risk becomes a growing percentage of what's left, which accelerates you towards zero exactly when you can least afford it. 0.5% of current equity, recalculated every trade, keeps your risk proportional in both directions. Calm. Let's zoom out, because I want to tie all of this together into something you can actually use, not just a list of concepts. The mistake most traders make isn't a lack of information. If anything, most traders have too much information, too many patterns memorized, too many indicators stacked on a chart that's already unreadable. The mistake is treating shape as if it were the same thing as edge, and treating a small cherry-picked backtest as if it were statistical proof when it's really just a story that happened to confirm what they already wanted to believe. Real edge lies at the intersection of three things: structure that has genuine liquidity significance, confirmation that a real liquidity event actually occurred, and timing that puts you in the market when real size is actually moving. Layer disciplined risk management and consistent execution on top of that, and you have something closer to an actual statistical edge, instead of a folder of memorized candle shapes that happen to work often enough in a backtest you didn't stress test properly. Frustrated, I wasted almost 2 years trading patterns without context, defending a backtest that only covered a favorable 3-month window, and blaming the market every time it stopped working. None of that was the market's fault. I was measuring the wrong things, and I was too attached to being right about a method I'd already spent months learning to let it go easily. Serious. Here's your actual takeaway, the one thing I want you to walk away from this video with. Before you trust any pattern, any setup, any strategy, ask yourself 3 questions. Does this have real context, structure, and liquidity, not just a shape? Have I tested this over a long enough sample across different market conditions without cherry picking? And am I filtering for asymmetric risk to reward instead of chasing a high win rate that collapses under one bad streak? If you can't answer all 3 honestly, you don't have an edge yet. You have a story you like the sound of. Calm. Next video, I'm going to walk through, screen by screen, exactly how I mark untested order blocks and gained or lost levels on a live BTC chart, step by step, so you can see the actual process instead of just the theory. Until then, go back through your own trade history and honestly ask which of your setups have real structure behind them and which ones are just shapes you memorized from a book.